This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move into the chart deck. Did the Fed kill the reflation trade? Listeners, you'll find the download link to the chart deck in your Research Roundup email. Now, if you don't have a Research Roundup email, don't feel left out. Just go to our MacroVoices.com homepage and click on the red button that says Looking for the Downloads. We'll get you signed up and send you the links. Patrick, before we get to the S&P 500, let's talk about the reflation trade in a little more detail than we had time for in the market wrap.
Right. And so I just really wanted to comment on one thing in the market wrap that you said, which is actually so true, which is that one day does not make a new trend. And watching how the market develops here in the next week or two is in my mind incredibly critical. And so this chart deck that we put together here is really just looking at the first 24 hours in the post-Fed period and the trend moves that are broken and the things that have to be watched in the coming week that are going to show the hand as to whether, in fact, the reflation trade has reversed or whether it was just noise. And so let's dive into it. The first thing that I wanted to touch on is the S&P 500 on page 2. Out of all of the global macro markets, it's the S&P 500 that actually made the smallest and most muted reaction. For me, though, I don't think that that is something that traders and investors should overread into. We are going into a quad witching expiration on Friday, and the gamma pin is as big as it gets. And the S&P 500 staying within a 50-point range into Friday's close, even on a surprise announcement from the Fed, was the base case. And though that we're going to end the week probably in a very tight range, what will be the real question next week is when volatility does return, and it will return, is it going to be a sort of a delayed reaction to this idea that there's a Fed tightening? On balance, I mean, look, the market could go either way, but it is more vulnerable to the downside on this. And I wouldn't expect it today or tomorrow in order to make that reaction. So Monday, Tuesday, definitely by the time we're recording next week's MacroVoices interview, I think there's going to be a lot of really important information in terms of whether or not the downside volatility actually kicks in. The interesting part about this reflation trade passing out in terms of, or potentially rolling over, is the idea that maybe the FANG stocks actually finally turn back up. And those are the large behemoth names in the index. And while we could end up seeing selling in everything from financials to cyclicals, the interesting storyline will be, can the index remain more muted on the idea that maybe we see rotation back out of the cyclicals and into these kind of growth FANG stocks that play a very defensive role in a period where we have some sort of disinflationary surge. And that's 100% the thing to watch next week.
Patrick, I could not possibly agree more. Next week is what we need to watch. What happens on a quad witching day tomorrow is not really going to tell us where this market is headed next. Well, Patrick, as we review the various different asset classes that we cover in the market wrap with the benefit of charts, I think you've already covered the S&P 500. Let's move on to page 3 and the U.S. dollar index. Boy, look at those two green candles. Is that the beginning of something, or is it just maybe a little false alarm?
Again, one day doesn't make a new trend, so we don't want to commit to a massive trend reversal just 24 hours after the Fed announcement. But the one thing that we know is that there was a major support line, that 5-year support line that we've talked about week after week on the show, that held. And typically, after a support line holds, there's typically some Fibonacci-style retracement or some mean reverting correction that happens the other way. A punch up to this 92 level is actually a very natural reaction reaction. What really is going to be the tell is whether or not the bulls can hold these gains. I mean, if we find ourselves by the end of next week back down to under 91 and heading down toward 90 again, and it was just one big fake out, then nothing has changed in the bigger dollar view that we had. And so really, after a big move like this, it's really about whether this has shifted the buying and money flow and capital flows, and whether the US dollar under a more hawkish Fed could potentially start to see a strengthening. And certainly the breakdown in the euro was a big tell. And with the yen almost pressing, the US dollar yen almost pressing north of 111, the dollar trend could emerge. And so that's 100% something that has to be watched into next week.
Patrick, let's move on to the Bloomberg Commodity Index chart. Boy, look at that big gap.
Right. And instead of going into a lot of the individual commodities, I wanted to just show the bigger commodity index, because we've seen massive turns in lumber. All the grains have rolled over. Copper has broken down through short-term retracement levels. We actually see an incredibly broad break on the downside in commodities. The only commodity that's held up is crude oil, which is on page 5. And even though that has had that one-day reversal candle, but that's actually what's held because of the weighting in the commodity index. That's what actually has held this chart up pretty well. And the fact that the commodity index has broken those May lows and it's really rolled over without oil contributing to the selling is a red flag. Again, one day doesn't make a new trend, and the best thing that could happen for the bulls is a quick and rapid reversal where this ends up proving to be a buy on dip, and they quickly rally it back to 92, 93, 94 on the upside in the coming week. If that happens, then that could neutralize it. But this kind of a break is a big red flag, like a canary in the coal mine. We have to see whether that begets more selling and whether there's a dynamic and deep retracement of that now 6-month rally off those November lows. With that said, Eric, let's go and actually look at that crude oil chart on page 5, and you can see that red reversal candle. It's certainly nothing that changes the primary uptrend. There are numerous occasions over the last 6 months where we've had these 2, 3, 4, 5 day sell-offs where crude oil pulls back $5, and it's just a buying opportunity on the dip that reverses back up and becomes a new trend. And so it's far too premature to already be calling a major top in crude, but at minimum, some sort of a profit-taking cycle or small correction back to some moving averages is entirely on the table. But really, the bigger question I have is that can crude oil buck the trend? If we are seeing a broader turn in the entire commodity complex, can oil just march to the beat of its own drum? I mean, gasoline futures did not confirm with a higher high. There's all sorts of divergences in a number of the other commodity markets. Can crude oil just avoid succumbing to all of that and keep the trend higher? And that's one of the bigger questions I have in my mind. Do you have an opinion on it?
Well, I think we should really quantify this around where the different risk scenarios are, Patrick, because there's different ways that this could play out. I think what we both agree on very much is what we see here is very consistent with exactly what you would see if it was a top and a reversal of trend, a very sudden change in a fairly dramatic, downward move, but it hasn't moved very far yet. That is what a top looks like. If this was the beginning of a topping and, a reversal down to $30 or something, it would look exactly like this. You and I both have a pretty strong hunch that that's not what's happening here, and that, if anything, the trade is to fade this. Now, I would love to see crude come back down. What are we at? 70 spot 13 on this chart. I'd love to see it come back down to 68 to the breakout zone there, just to sort of test that breakout zone as support, because that just gives the market more strength to move higher. If I see that further weakness down from 70 down to 69, down to 68, even down to a 67 handle, doesn't bother me at all. I look at that as great news for the bulls, buying opportunity to add to my positions. Everything's good. Now, if you start getting daily closes below that March high, which was around 66 and change, and it stays there for a few days, it really starts to paint another picture. But going back to what you said, Patrick, You said if the reflation trade is already over. Frankly, I think you and I agree that the reflation trade probably is not really over. But if the reflation trade is over, which we both don't think it is, well, then, look, this is probably the beginning of a reversal. That probably was the top, and there's probably a whole lot lower to come in oil prices. I don't think it's going to go that way, though.
Well, so Eric, we do have to then touch on gold, right? On page 6, I have that gold chart, and what a nasty break that was. I mean, we were overdue for a gold correction after such a run, but my first approach to it was that there was a buy on dip whatever gold break we had. But the velocity to the downside in this post-Fed period is just is mind-boggling. I mean, the fact that we wiped out this much this quickly, it makes buying the dip a little more challenging. The big question really is in this kind of 1775 to 1800 level, can the bulls hold it in along this line? Because in order for a bull trend to really be in play, you should see a sequence of higher highs and higher lows. Any real further selling in gold really does open the window for a full retest of those March-April lows. And if we're going and retesting bottoms, then it's not an uptrend. And so the gold is about to give a really big technical tell. I mean, the big question, of course, is its correlation to real yields. And right now, while we see the long end curve, we'll get to bond markets and yields in a moment, but what's happening is inflation expectations got hammered, and inflation expectations dropping at a pace faster than the yields are moving on the long bond actually means that the real yields are getting really wobbly here, which I think is spooking the gold markets a little bit. But whether or not inflation expectations are going to really reverse in a more meaningful way, and more importantly, whether or not that long bond really starts to move in a big way, it's going to be the big puzzle piece. I think gold is going to stick with that correlation, and the next big move is going to be a tell on that.
Well, Patrick, I think gold and crude oil are almost the same story. Basically, if we're right that the reflation trade is not over yet, then what's happening here is a gift. It's a buying the dip opportunity. And I would say, of course, you can never call these things exactly, but at 1772, where we are on this chart, I think that's probably a pretty good spot to think about buying the gold market, if we're right, and this is the knee-jerk and nothing more. Now, obviously, if we're wrong and the reflation trade is really dead, I think it's a lot lower than just the recent lows. I think it's like 1400 is the next stop. And frankly, I'd welcome that because I'd buy that too. I'd say if there's a trade here right now for me, and I'm not planning to put it on, but if I was going to consider putting a trade on, it would be out of the money protective puts to protect my existing long position so that if we do get a really hard break below, let's say, 1675 where the previous lows are, it takes us all the way down to 1500 or something because everybody's convinced the reflation trade is not happening, or maybe to 1400. I don't know. I'd love to be hedged against that so that I can afford to buy even more to add to my longs when we get there. So that's the trade that appeals to me here if I was going to put one on.
All right, well, we have to wrap up this entire post-game by talking bonds, because what's interesting here is that it's no longer just a story about the 10-year yield. It's a story about the yield curve, and more importantly, about whether or not the steepener that's been in place for a better part of 6-7 plus months, whether or not we've entered a flattening of the curve. And what an interesting reaction we've seen in the bond markets. And so what I put on pages 7, 8, and 9 is the 5-year, 10-year, and 30-year U.S. government yields, bond yields. And what we have is you can see that the 5-year government yield popped from 75 basis points to close to 90 basis points on the first reaction. The big move in yields was in the belly of the curve. And while we saw that 5-year move, when we go to the 10-year, we are pretty flat on the reaction to the Fed. But if you go to the 30-year, we have yields actually outright breaking down versus where the 5-year was breaking out. This has really flattened the curve. And this is what actually I think is contributing to spooking the markets. So just to kind of show that on pages 10 and 11, I have the 210 spread, which is just starting to roll over. But look on page 11 where we have the 530s. really with that 5-year yield breaking the way it has and the 30s actually breaking down, we have had a complete and total reversal in this and a complete flattening. And this is not just a knee-jerk reaction. This is wiping out literally 6 months of steepening in 2 days. And so this is an extraordinary move. And this is actually the one thing that we can't take our eyes off of, because the entire reflation trade often has the steepening as a key component to it. And if we have a flattener kicking in here, what does that mean? I don't want to overread into 1-2 days of price action, but boy, we can't ignore this. And that's something I want to continue to have the conversation in weeks to come.
I'd love to know what our friend Juliette de Klerk is doing here. She trades 530 spreads a lot and has a pretty good track record. We'll have to get her back on sometime and see what she thinks and what's behind this. Patrick, we've looked so far at the yields and we've looked at the spreads in yields. Let's translate that to what you can actually trade, which is the TLT ETF, which of course is 20-plus year average maturity Treasury Bond Fund, or ETF.
Right, and we had like a month ago David Rosenberg on the show, and he actually was calling going into that third quarter that bullishness in the long bond, and boy, is this Fed hawkishness really put this in play. That Treasury bond, during that bond bear market, we saw that $30+ wipeout of the TLT during what was just a bond bloodbath. There was no other way to put it. But after several months of basing, and now this turn. It'll be really interesting to see whether the long bond is going to actually trend higher. And again, if we see that like we were saying earlier, 1 day doesn't make a new trend. But if we have a US dollar that starts to trend north of 92, and at the same time the long bond starts to push higher, those are red flags and canaries in the coal mine that the reflation trade may begin struggling, and we have to really reevaluate our positions on this. And again, 1 day doesn't make a new trend, but boy, is this for the first time in months, we have a market that's interesting and some big moves are happening, and you can't take your eyes off of it now.
I don't know, Patrick. The crude oil market's been pretty interesting for the last few months.
Well, outside of crude.
Okay. The little markets are getting interesting again.
Yeah.
And, of course, if you want to be a big picture trader on these big markets, you need to sign up for a free trial of Patrick's service, Big Picture Trading, where you can get chart decks like this almost every single day from Patrick. Information is on page 13 of the chart deck.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.